That's the paradox of asymmetric risk. It looks uncomfortable before it becomes obvious. When gold and silver prices consolidate, or when sentiment around them fades, that's often when their risk-reward potential is at its peak. The asymmetry emerges because people are anchored to narratives. Inflation is under control. The central bank has this covered. Fiat will always have value. But reality doesn't operate on narratives. It operates on fundamentals, on supply, demand, trust, and scarcity. And in all those measures, the asymmetry is glaringly in favor of real, hard assets. One of the key principles of navigating such transitions is understanding convexity, a concept where a small change in input produces a disproportionately large change in outcome. Gold and silver today are convex assets in a concave world. The system around them, currencies, debt, and policy, is rigid, leveraged, and overextended. When pressure builds, rigidity breaks. Hard assets, on the other hand, don't rely on anyone's promise to perform. Their convexity comes from that independence. A small shift in global confidence towards safety could produce massive capital inflows into these markets, creating outsized returns relative to the risk taken. It's important to recognize that the world's capital pools, pension funds, sovereign wealth funds, hedge funds are enormous relative to the size of the physical gold and silver markets. Less than 1% of global financial assets are allocated to precious metals. That means if even a small percentage of capital seeks refuge there, the revaluation would be explosive. That's the essence of asymmetric opportunity, when the probability of a large gain far exceeds the probability of a large loss, yet the world is mispricing it. But to benefit from asymmetry, one has to think differently. You can't chase consensus. You must see where the crowd's blind spots are. Right now, the crowd is focused on nominal returns, liquidity, and central bank reassurance. They're ignoring purchasing power destruction, structural debt dynamics, and the erosion of fiscal discipline. These are not theoretical risks, they are observable realities. And when those risks manifest, the crowd will pivot all at once, but by then the asymmetry will be gone.